Valuation, Measuring and Managing the Value of Companies, is a comprehensive guide that provides readers with an in-depth understanding of how to assess the value of a business through strategic analysis, forecasting, and the application of various valuation methods. Renowned for its practical approach on how to make sound investment decisions and manage corporate value, this book serves as an essential resource for finance professionals, investors, and business students alike. Here's our pick of the top 10 insights from the book. 1. Traditional accounting measures like PE ratios can give misleading signals about a company's true value because they don't account for growth potential and cost of capital. Buckle up, because it's time to dig deeper than a treasure seeker in finance land. Traditional accounting measures such as PE ratios are the financial world's equivalent of judging a book by its cover. Sure, it's quick, easy, and gets the job done, but you're probably missing out on the epic saga hidden within the pages. When it comes to assessing the dragon-sized potential of a company's future growth and the treacherous moat of its cost of capital, these ancient scrolls just won't cut it. It's like turning up to a joust with a pool noodle, theoretically entertaining but ultimately futile. To truly knight your investment decisions, a valiant investor must juggle both the magic beans of growth potential and the weighty sword of capital costs. Only then can one claim the true treasure, the accurate value of a company's kingdom. 2. Investing in a company with low growth prospects but high cash flows may lead to better returns than investing in a high growth company with uncertain profitability. Think of it like this: betting on a tortoise with a hefty bag of gold coins might actually be more rewarding than backing a hare that's high on energy drinks with an empty wallet. The tortoise, our underappreciated low growth company, steadily plods along, doling out solid cash flows. That's like having a reliable friend who never forgets to pay back the lunch money. Meanwhile, the hare, aka the hotshot high growth company, is sprinting with the buzz of potential success, but with no clear plan on how to fill its coffers. That's the friend who promises you concert tickets sometime in the future. Sure, the hare's future could be dazzling, but your bank account is more interested in the tortoise's consistent generosity today. Sometimes, slow and rich wins the race and pays the bills. The value of a company is not static, but changes with market conditions and strategic decisions by management. Imagine a company as a chameleon, constantly adapting its colors to the ever-shifting hues of the market landscape. This is the essence of corporate value. It's not some dusty, set-in-stone number etched on an ancient abacus. No, it's more like a live stock ticker, dancing in step with Wall Street's mood swings and the strategic tango performed by the C-suite executives. When management conjures a masterstroke, the company's value can soar like an eagle, but let them fumble, and it might plummet like a graceful, if somewhat bewildered elephant dropped from a hot air balloon. Make no mistake, the valuation game is less monopoly and more 4D chess, where business acumen meets the crystal ball of market fortune telling. 4. Discounted cash flow (DCF) is a powerful tool for valuation, but relies heavily on accurate forecasts of future cash flows, which are inherently uncertain. The discounted cash flow, or DCF, as the cool accountants call it, masquerades as your financial crystal ball. It's like trying to predict the taste of a cake you've yet to bake, which can lead to a culinary catastrophe or, in this case, a fiscal fiasco. But don't let the complexity fool you. While DCF is a numerical soothsayer, it demands that you gaze into the future with a clear-eyed view. Accurate forecasting is the name of the game, yet as reliable as a weather forecast during a butterfly migration. Miss the mark, and your valuation might just flutter by like a misplaced decimal point in a spreadsheet of doom. Remember, Your adroit assumptions today can either be tomorrow's treasure or trash. Prophesy with caution. 5. Small changes in the assumptions used in valuation models, such as growth rates or discount rates, can have outsized effects on the estimated value of a company. The mystic arts of valuation, where a decimal point moving like a ninja can slash or inflate a company's value like a balloon in a sword fight. Those growth rate assumptions you casually tweak, they're not just numbers. They're the financial equivalent of spinning the wheel of fortune, except here the prize is your investment's fate. And let's not forget the discount rate, the blood pressure of the valuation world. Change it a bit, and the value of the company either skyrockets like it's strapped to a financial rocket or plummets like it forgot to pack its parachute. The moral? Handle those assumptions with the care of a bomb squad diffusing a ticking market explosive, because in the high stakes game of valuation, even the smallest twitch can turn your model into a wildly cheering success or a face-palming fiasco. 6. Synergies, often cited in mergers and acquisitions, can be overestimated, leading to paying a premium that may not be justified by actual value creation. The siren song of synergies in the grand opera of mergers and acquisitions. It's almost like imagining unicorns prancing in a field of cash. But let's face it, those mystical creatures often turn out to be plain old horses once the honeymoon phase of the merger wears off. The allure of cost savings, cross selling, and combined efficiency can dazzle like a disco ball. But once the party's over, investors are often left holding a hefty tab with little to show for it. The moral? Look before you leap into the synergy pool. It might be shallower than it seems and filled with more mirage than magic. 7. Intangible assets like brand strength, patents, and proprietary technology are often undervalued in traditional valuation methods, despite being critical to a company's success. A company's valuation often gawks at tangible assets like it's eyeing the last slice of pizza at a party, but the real MVPs, intangible assets, are like the unnoticed quiet kid who's actually a genius. Brand strength, patents, and proprietary tech might not strut down balance sheet boulevard, but they're the secret sauce in the corporate success burger. These invisible titans shape customer loyalty, erect barriers to entry as formidable as a castle moat, and often hold the magic spell for future cash flows. Old school number crunching may give them the cold shoulder, but savvy investors court them like they're the belle of the Wall Street ball. 8. The concept of economic profit, which adjusts for the cost of capital, provides a more accurate measure of whether a company is truly creating value. Picture this. Economic profit is the business world's version of a reality check. It's like telling your friend who brags about their high paying job, "Sure, but have you paid your bills yet?" Just like that friend, a company might boast about its profits. But the key question is, after settling the tab with the capital costs, those pesky silent partygoers who always expect a slice of the cake, are they still the life of the party? Economic profit strips away the fancy accounting veneer, revealing if a company is a true value creating ninja or just playing financial dress up. It's the metric that separates the corporate wizards from the wannabes, ensuring that the roar of profits isn't just an echo in an empty cash cave. 9. The market doesn't always price companies correctly due to irrational behavior, informational asymmetries, and short term focus, creating opportunities for value investors. Investors, the archaeologists of the market, sifting through the muddled layers of sentiment, news, and the occasional tweet from influential CEOs that send stocks wobbling like a newborn giraffe. Valuation offers a juicy tidbit for those willing to wield their financial spades, the mispricing of companies. Amidst the irrational exuberance, the cloak and dagger secrecy, and the attention span of a goldfish that epitomize market behavior, lies the fertile hunting ground for value investors. These patient species of the financial fauna lie in wait, ready to pounce on those underappreciated gems the market has mistakenly tossed aside like yesterday's news. Golden opportunities, they say, but only for those with a sharp eye and an even sharper calculator. 10. Real options valuation can capture the value of managerial flexibility and strategic opportunities, which are often ignored in static valuation models. Imagine you're at a buffet with a static plate model. You can only pile on what fits, and that's your meal's value, period. Real options valuation, on the other hand, is like a magical expanding plate. You can keep adding opportunities as they appear, like an extra slice of strategic roast or a dollop of flexible gravy. This model acknowledges that a savvy manager is like a chef with a secret pantry, able to whip up value with ingredients, read business decisions, that aren't locked into the initial recipe. Where traditional models might see a dead end, real options valuation sees a portal to Narnia, wardrobe full of profitable adventures, as long as you know how to spot the lion, the witch, and the wardrobe's hidden door. To sum it up, valuation, measuring and managing the value of companies, underscores the complexity and dynamism in company valuation, emphasizing the limitations of traditional metrics and the importance of incorporating growth potential, strategic decisions, and intangible assets. It highlights the sensitivity of valuation to assumptions and the significance of more robust methods like DCF and real options to capture the true value, while also acknowledging the market's occasional inefficiencies that offer opportunities for astute investors. Thanks for watching.